So this morning, talking about bills going up after the Bank of England raised interest rates to their highest level for 14 years yesterday, and what's it to have an effect on things like broadband bills, we've spoken about that, mobile phone bills, food costs. It'll be felt hardest by those with tracker or variable mortgages, or those whose fixed mortgage deals are about to end. So is there anything we can do to soften the blow? Well, Malcolm Davidson will know. He's a mortgage broker and the founder of UK Moneyman in Hull. Welcome, Malcolm. Nice to see you.
Good morning.
I was overexcited just to have a human being in the studio, but it's lovely to have you here. So first of all, there's a lot of people who'll be hearing these numbers and start to panic. And you must hear this a lot with people saying, well, what does it mean for us? What does it actually do to our mortgage? What do these interest rates mean for us?
Yeah, that's right. And we've come off an extraordinarily long period of record low interest rates, haven't we? So really going right back to the credit crunch. So the issue for people at the moment is it's been so sudden. So we've gone from the base rate at under 1% to 4.25 in the space of a year. So it's a year's worth of consecutive rises. So anyone that's been a first time buyer in the last decade, of course, this will be the first time they've experienced anything like this. However, the more mature of us will remember when interest rates were significantly higher than this. So it's not now which is the kind of the weird and wonderful time. This is normal. It was the last decade where the money was so cheap, and we've certainly seen the end of those mortgage rates at 1 or 2%. And yeah, it is confusing for people, and that's why they need to kind of reach out for help and advice ahead of their deals coming to an end.
So, I mean, we were talking off air saying years ago when we got our first mortgage was an interest-only mortgage because that's the only mortgage we could get. And I remember the interest rates on that being particularly high. As you said, in some cases, I think it was 10% at some, and a lot of us will remember those kind of mortgages. Do you think, we've kind of, as the years have gone past this kind of 2 and 3%, we've kind of been a little bit, I'm trying to think of the word.
Complacent.
Yes, complacent about that.
Yeah, for sure. I think so. And like I said, any younger applicants, it's coming as a real shock because each time they've renewed their deal up until now, payments have been coming down, but this time they're looking at hikes of a couple of £100 a month in some instances, which is all you need, isn't it, when everything else around you is going up as well. But there are things that people can be doing to minimise the impact of this, but those cheap deals have unfortunately gone, and we're not going to see them back. The other good news is, despite the fact that the base rate has been going up, very interestingly, fixed rate mortgages have actually been coming down since that calamitous mini budget in October or November. What happened at that point was the banks had no idea, like the rest of us, what was going to be happening with the economy. They ran for the hills and spiked up their mortgage rates from about 4% to sort of 6.5%. So if your deal was coming to the end of its fixed rate at the end of last year, there really was time for panic. Since then, however, things have become more stable under the new administration. And there's been no catastrophes for the last couple of months, right, which is almost a lifetime, it feels to us. Nothing's kind of going on. And fixed rates are now back to the pre-October budget level. So we're back to roughly where we were in the autumn.
It's always a confusing minefield when I look into these, all sorts of different types of mortgages. Just explain briefly, what is a tracker and a variable mortgage, and how do they differ?
Well, most new borrowers take out fixed rate mortgages, so they're unaffected by these month-to-month changes, and that's that peace of mind that you get of knowing for 2 years, 3 years or 5 years that your payments can't change, and that's what you're buying into. When that fixed rate expires, you will drift, if you take no action, onto the lender's standard variable rate, which will be significantly high, probably over 6%. So if you're in that situation where your deal is coming to an end, your fixed rate deal is coming to an end, you need to be reaching out online, speaking to a mortgage broker, speaking to your existing lender 6 months before your deal finishes, because that's when you can lock in. But you don't have to lock in at that particular point. You can choose to leave it until the last minute. However, the process of changing lenders can take a couple of months, so you don't want to be leaving it to the very last second if you are in that position where deals come to an end. The variable rates are the ones that are affected immediately by these changes, because your payments would go up £20 or £30 a month on an average mortgage if you're still on a variable deal. Most people, however, are on fixed rates.
So if your mortgage is going up £20 to £30 a month, and that's going to have a significant effect on you, what can you do about that? Is there anything?
Yes, definitely. So it is your biggest outgoing normally, and it always sort of confuses me why people shop around like mad on the car insurance and pet insurance, and yet the biggest outgoing, sometimes you come across people sort of taking no action. But if that letter's coming at you month after month after month and your rates are going, I'm sure by now you've reached out to your current lender or to a mortgage broker for some advice. Your current lender will offer you a deal to stay with them, a fixed rate to stay with them if that's what you want to do, and brokers can go to the market and see what else is out there by way of comparison.
It's interesting that you say, we do shop around when it comes to, where we get our energy bills if we can. Even we were talking about, shopping around for the best mobile phone rates. And yet when it comes to the mortgage, which is what invariably we pay out most on, very few of us actually think to shop around.
Yeah, that's true. But technology is with us now. So what we like to offer all your listeners today is access to our mortgage dashboard. What the dashboard does, it tracks your current deal, taking into account any penalties that are available, that are payable to come out of your current deal, taking into account all the current deals that are out there, and it works out for you whether or not you should be sticking with the deal that you've got or coming out of it early. So anyone that wants to benefit from that is completely free. They can just reach out to me, and I'll happily give them access to their own mortgage dashboard, and that way we can at least have the confirmation, that peace of mind of knowing that the deal that you're on is the best deal for you.
How about first-time buyers, people trying to get a foot on the property ladder, seemingly getting more and more difficult as we go on? What is it? Is it the fact that they are just not being able to actually get a mortgage because of their, not enough credit rating or etc., or the interest rates are too much? What's going on?
Well, the property market is extremely resilient. Okay, so if people, it's not like rents are getting cheaper, by the way, because landlords are having their costs, mortgages going up as well. So they're passing those costs on to their tenants. So we're a country of home buyers, aspiring people to want to get on the property ladder. And what we're finding is that whilst quarter four was quiet and people had that uncertainty of what was going to happen next, that has now evaporated, and people are saying we're not prepared to wait any longer. As long as the mortgage payment is affordable, and we make checks on that, and the lenders do as well, and it's comparable with the rent that they're currently paying, we're seeing that first-time buyers are still looking to do it. The challenge that first-time buyers have got with all the squeeze on living costs is how do you save a deposit, especially when you're renting.
When it comes to people who are actually just struggling to afford their mortgage at all, and they're terrified that their home is going to be repossessed, when you get to that level, to that stage, is there anything you can do?
Yes, definitely, it's a real disaster, not just for obviously it's a crisis for a homeowner to get into that position, and it must be highly distressing, but it's a disaster for a lender to take a property into possession as well. They do not want that to happen, because then you're passing the problem back onto the bank. Some people think that any equity over and above the mortgage balance is retained by the bank. That is not the case. That gets passed back to the borrower, but the bank has then got to take responsibility for insuring the property, securing the property, putting it on the market and selling it. So they really don't want that to happen. So the advice to anyone that's struggling to make their mortgage payments is to open the line of communication with their lender as quickly as possible. They will treat your situation as sympathetically as they can. They can arrange payment plans, perhaps a period of interest only, but don't just bury your head in the sand. Talk to your bank. They don't want to take the properties into possession until it's a last resort.
So I suppose, as you said there, your advice for everyone, whether they're they're on their tracker mortgages, etc., or they're just trying to get a foot on the property ladder, is try and remain calm. There are things we can actually do. Shopping around is one of them. Comparing is another. But try not to get too panicked about it. Yes,
it could be worse. You could live in Argentina and interest rates are currently at 78% and inflation's at 100%. So we're not quite at those levels yet.
Well, hopefully not. My goodness, that shocked me. Malcolm, thank you so much for coming in. It's been very informative and lovely to chat to you.
You're welcome anytime.